So let's get some opening thoughts. Kaustubh, we'll start with you. In the last few years, the passive fund segment has seen a significant spike in terms of interest in the investor community, as well as the volume of assets under management. So what, in your opinion, could have spurred this shift?
Sure. Hi, Gautam, and hello to all my fellow panelists and the investors on this webinar. So, Gautam, you're right. When you set the context saying that passive has really seen this increase in AUM, I mean, you put some numbers out there, 40% growth in ETFs, and really a couple of things have happened, right? So, one is, you've seen individual investors. I mean, traditionally it was the bastion of pension funds and EPFOs of the world that invested into the passive funds and the ETFs. But over the last couple of years, you've seen retail individuals, HNIs, who have really been coming, to invest in passive funds. And so we've seen a large increase in the retail assets in this. And there are multi reasons as to why that's happened. I'll just lay them out, one by one. One is obviously when you look at equity investing, there are a lot of new investors coming in. We know that the last few years have been an interesting polarized market, especially the years of 18, 19, 20, where active funds in a sense have had a little bit of a tough time as compared to their passive peers. So with the advent of new investors coming in, they are looking to, if I want to take an equity exposure, I don't have the wherewithal to decide which active fund to pick and stick with it. Why would I stay out of the market? Let me buy a passive fund, right? So I think that is one change that's clearly been happening, and we expect that would continue going ahead. The other interesting bit is international investing, right? Indians have finally warmed up, started to move away from that home bias and started looking at international funds. And I think one interesting piece of the pie is, you have a lot of passive sort of, funds, international funds through the ETF or the fund of fund route, which investors can buy, right? You take exposure to the NASDAQ and other popular indices like that. And I think that's the other route which has really increased the interest in passive funds from an Indian investor's context. The third and a very interesting development which has happened over the last few years is fixed income passives, right? We've seen a fair bit around, the government obviously taking steps in terms of, be the bond or, a lot of funds that have come around state development loans and PSU bonds. And I think that's another interesting element where, given that interest rates have, been at the lower end, people are not sure of, I don't want to take credit risk. I want to expose myself to limited interest rate risk. I think passive fixed income funds have really played out. So I think these are the three kind of key mega trends that have happened, in terms of why that shift towards passive, the increase of interest in passives from individual investors.
All right, Kaustubh. Thank you so much for outlining the clear factors which have encouraged this shift towards passive. Although when we talk of, say, passive fixed income products, it is an interesting time considering where interest rates are supposed to be headed from here on. And as I was discussing with Bhupesh earlier, 10-year bond yield of 6.88% gives you a pause for thought. But moving on, Abhishek, we've had this discussion on passive investment, but to outline for our investors and to recap what you've always said, in what ways is the passive investment strategy more beneficial than the active one? Your thoughts on that?
Yeah, so good afternoon, everyone, and warm welcome. So, Gautam, as we discussed earlier also, and as Kaustubh outlined, the last few years have already seen a lot of investors realizing that you need to have exposure to different asset classes, and at the same time, you also need to look at the cost of investment in your portfolios. Now, given the fact that passives in most cases are index hugging strategies and they generally just deliver market returns or slightly over or under that, the biggest benefit of the passive investment approach is the transparency and simplicity. There's no black box about passive funds. You don't have to really think through for understanding the strategy. Rather, in case of active funds, it's more like a black box where you have to really follow the fund manager's style, study the portfolios over time to understand the strategy, and still be subjected to human error. In case of passive funds, the error is only what you induce in your own portfolios. Given the fact that most of these are very, very low expense products, it constitutes a very, very large saving for the investor. Just for an example, a typical index fund will be priced, a direct plan will be priced in the range of about 15 to about 30 basis points on an average. And in case you're looking at a fixed income product, it might be even lower. In case of active funds, the direct plans will be somewhere between 70 to 105 basis points. It's constituting about easily 50 to 60 basis points on the minimum, and then more. With this money being reinvested in the strategy, clearly the benefit is for the investor. And the third and very, very large piece of growth that we've seen over the last few years is for institutions and for larger investors like HNIs, family offices, passive funds, transparent index tools at low cost. They're basically like a Lego set for them. They want to build a portfolio in a certain way, they can do it. They want to, change it over a period of time without much churn, without inducing cost. They can do that. So for a variety of investors, with low cost, low churn, it tends to be a very, very, very effective tool in the portfolio, especially for investors who are new to market or who are conservative investors. This is a brilliant tool to actually enter the market, wet your feet, and then see if you want to take on more risk.
All right. In a sense, they're training wheels for those who are looking to enter the market and wonder about risks and see how to make that first step. Fair point. Point taken. That's the outline of passive investment strategy and how it's more beneficial than the active one. Let's move on to Kanika for her thoughts on taking the passive fund route for, say, getting international exposure of your portfolio. Your thoughts on that, Kanika? Kanika, if you could unmute yourself.
Hi. Okay. Sorry about that. Hi, everyone. Very happy to be here. So two parts, right? One is the shift to passives is not something that's new. When you look to the West and, India lags a little bit in terms of product development, there has been such a clear shift away from humans into rules-based investing, right? Globally and, particularly in the US, you look at retail tickets, less mutual funds, more ETFs seems to be the way forward. Even at HNI ticket sizes, top 5 hedge funds in the world are also all quants now, right? Which are rules-based products. So that theme of rules-based investing is here to stay. Now, active and passive are two different, sides to that coin, but this is one overarching umbrella that we are seeing, and that's why at Upside, those are the kind of things we ended up building. Now, specifically on international exposure. I think it's very important that people start with passives, right? I think Kaustubh was mentioning how it's important to take international exposure. Absolutely right. Currently, no matter how diversified you have one very large risk, white elephant India risk that you're sitting with. Important to diversify away from that. Get US, get China, get Taiwan. Lots of different interesting products being offered. And now, once you say, "Okay, I want to go to the US," how do you decide what to get in the US, right? I think Buffett. In his most recent, annual conference was talking about this. In the 20th century, auto was your hottest sector, right? Everyone had to get into auto. After that, there are some 2,000 defunct companies in auto, right? End of 2008, there were only 3 auto companies. So how are you going to pick your auto winners, right? Just deciding that a sector is hot is not a good enough way to decide to invest in it. Which is why ETFs are such a great place to start. Like you said, training wheels and whatnot, especially going into foreign markets. So that is to us a very, very strong belief. One is you need to diversify away from India a lot. 2, you need to start looking at other geographies, and ETFs are such a beautiful way to do it. So extremely bullish on that approach.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.